the last 3-4 months, the Nifty has given a good run up by 30% from 15K level to 19K level. This is a sharp rally given the macroeconomic conditions the world is facing. As a retail investor, what should be our next course of action? Should we book our profits from the stocks and our mutual funds, or should we continue to hold them? In this video, let us make a detailed study about the current situation of the market and do both fundamental and technical analysis as to where exactly our markets are and the course of action that needs to be taken. Welcome to holisticinvestment.in. First, let us start with the fundamental check, the PE check. The PE ratio is widely used measure to assess stock valuation, and similarly, the Nifty indices also have their own PE ratio representing the combined PE ratio of the top 50 stocks in India. Now let us look at the last 2 years PE ratio. As shown here, there is some interesting trends. It reached a peak of approximately 27.5 in October 2021, but has since declined and is currently trading at a premium of approximately 23. This suggests that the market is not overvalued, but rather fairly valued at the moment. Furthermore, we conducted a comparative analysis of Nifty PE levels with both long-term and medium-term averages, and the results are encouraging. Now a question arises, will the past performance determine the future? No. This past performance of India is a historical narrative and does not necessarily predict our future performance. Well, we have another metric to study how the future price to earnings will be, and this is called the forward PE. The forward PE ratio uses the forecasted earnings per share of the company over the next 12 months for calculating the price to earnings ratio. It is calculated by dividing the price per share by forecasted earnings per share over the next 12 months. As we do it for the Nifty 50 index, we put together all the EPS of top 50 companies into the calculation and arrive at the forward PE. Nifty's 1-year forward PE is currently at 18.7 times, exceeding the 10-year average of 17.4 times. Considering a projected 20% earnings growth in financial year 2024. Nevertheless, it remains significantly lower than the peak of 23 times observed in October 2021. Now let us move on to the relationship between PE ratio and returns. Based on research methodology conducted by AS Equities published in Economic Times, it has been observed that whenever the PE ratio falls below 20x, the 1-year forward returns have been higher. This was evident when there were extreme movements in the index. Jan 2003 PE 15x, forward return 88%. 2008-9 crash, PE was at extremely low level and 1-year forward return was over 80%. COVID crash of 2020, Nifty PE fell below 20x and the 1-year forward return was around 70%. On the contrary, PE surged over 35x in 2021 and followed by a drop in Nifty. So, in short, whenever the PE was less than 20, the subsequent year gave a return of almost 20%. When the PE is much less than 15, the projected growth is still higher as deposited here. Returning to our PE ratio, which currently stands at a premium of approximately 23, the outlook appears positive at this level. Next, we move on to the important check, the Buffett indicator. The Buffett indicator consists of 3 factors, namely the total market cap of the listed companies in India, the total GDP of India, the total assets of central bank. There are 2 variations in the Buffett indicator. The first one, Buffett indicator, is total market cap divided by GDP. In the second one, it is total market cap divided by GDP plus total assets of central bank. Though there is a debate as to which one gives a better view of the state of the economy, we will examine both of these approaches to assess our current scenario. Scenario 1, we divide the market capitalization by the total GDP and arrive at the ratio of 97.24 under the original ratio as defined by Warren Buffett. Scenario 2, we include the total asset of the central bank in our calculation and combine the same with the GDP and calculate this ratio. By virtue of this, the ratio comes down to 87.54%. Further, based on these historical valuation, the market valuation is divided into 5 zones. So, in both cases, we are well under control and are primed to move up according to this analysis. We can conclude that we are fairly valued in both. Next, we shall shift focus on to the foreign institutional investors. FII is fondly referred to as the market movers, especially in a developing country like India. They infuse capital into the market and can change the course of market within months. The amount of money they can invest is impossible to replace by domestic investors or any retailers. There are many instances where the FIIs have been acting as the catalyst in the market movement. The FII pulled out almost 65,000 crores during the COVID slump in March 2020, and we all know what happened after that. They have also led the recovery post-COVID. During the period from October 2021 to July 2022, FII was on continuous selling spree. They have pulled out a whooping 390k crores from the Indian stock market, and what has been the impact of this brutal sell-off? A fall for Nifty from the all-time high of 18,600 until 15,000. What happened post July 2022? The markets bottomed out and the FIIs made their first big purchase on August 2022. This led to the market reversal, and it started an upward trajectory and hasn't ceased yet. The most important point to note is that the FIIs have been consistently net buyers since March, and this has led to the Nifty reaching all-time highs. Next is B ratio. B ratio stands for bond equity yield, earnings yield ratio. This is another parameter that is used to determine the direction of the market. The ratio is determined by dividing the 10-year yield of government bonds by the current earnings yield of Nifty. The denominator here, the earnings yield, is also the inverse of PE ratio. B ratio of 1 is considered to be fair value, and value greater than 1 is said to be overvalued, and less than 1 indicates as undervalued market. When considering asset allocation, a value greater than 1 indicates a preference for investing in bonds and debt funds, while a value of 1 indicates the investment is directed towards equity. Now, let us look at the B ratio of India. India 10-year government bond has a 17.16% yield. India's equity market yield is 4.36%. So, India's B ratio amounts to 7.161 divided by 4.36, which is 1.5. This typically indicates a overvalued market. However, based on the data from 2020, the long-term average of B ratio for India was approximately 1.6 over 2 decades. This suggests that a value of 1.5 may be considered a fair valuation given the historical context. Next, inflation check. Inflation plays a critical role in influencing our purchasing power. As inflation rises, buyers experience the effects which can be felt in their ability to afford goods and services in the market, and vice versa. Though the correlation between the inflation data and the market data is not a straightforward one, we can derive some conclusions by just studying the inflation rates over the past few months and decide ourselves. Reduced inflation means increased spending power at our disposal. In India, inflation has experienced a downward trend in recent months, alleviating some of the pressure on the Reserve Bank of India to increase interest rates. Let us look at the current market condition with the help of fundamental analysis. The markets have reached an all-time high and inflation is stabilizing, while other essential parameters align to indicate favorable prospects for the long term. Fundamental indicators such as the PE ratio, Buffett indicator, FII inflow, inflation checks, and B ratio collectively point toward a market that is not overvalued now. Given these factors, the condition seems conducive to sustained growth and investment in the long term. To further strengthen our conviction, let us now check from a technical perspective as well. Next, RSI Check. The Relative Strength Index is a momentum indicator utilized to assess the speed of recent price fluctuation to gauge whether a stock is likely to experience a surge or a decline in value. When the RSI goes below the horizontal 30 reference level, it indicates a bullish signal and is considered to be oversold, implying potential price growth. Conversely, when the RSI goes below the horizontal 70 reference level, it indicates a bearish sign suggesting an overbought position, which may lead to potential price decline. And the provided chart depicts the weekly time frame set up on TradingView, featuring the 14 period relative strength index as a selected indicator, which calculate price changes over the past 14 periods. Based on this setup, we observed that the RSI indicated overbought conditions in both February and October 2021, preceding subsequent market declines. In the current scenario, the RSI for the year 2023 has already begun moving toward the median line, signifying that the market's valuation is not as elevated as it was in February or October 2021. When combined with the fundamental analysis that was previously discussed, we can deduce that Nifty's valuation is diminishing and is currently in a healthier state compared to its condition during the year 2021. Next, we will move on to an important aspect. What should be our course of action? The first rule of compounding is to never interrupt it unnecessarily. Now that we have learned that our markets are not as expensive as we had thought earlier, what should our course of action be? When we posted this question earlier in the introduction, we did not have an idea as to how the markets are prevailing. But that's not the case now. The answer is do not stop. Persist. Keep investing in your SIP regardless of whether the markets are doing well or not. You must have seen the image circulating on social media as why not to stop your SIP. This is true for reasons that SIP is convenient and gives people peace of mind in investing, thereby committing more time to his or her family and other priorities. The money you put in during the initial 6 years can make up to 58% of your total investment amount by the end of your investment tenure. If you had held these investments citing market condition or other factors, we may end up with a lesser corpus or get lesser than the expected CAGR. We would like to conclude with an interesting fact. If you stay invested for the long term, your daily gain even match the value of one entire month's SIP. This remarkable growth is due to the magic of compounding, which can only be realized when you remain invested over an extended period. Time in the market is more important than timing the market. So, embrace the power of long-term investments to witness the incredible benefits of compounding. A detailed blog post on market valuation is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.